Good morning, good evening, good afternoon, whatever time it is for you, wherever you are right now, and welcome to another session of Bizarre Financing. Today, we're going to look at how to deal with what potentially is coming in the economy, thanks to the fact that I happened to be around during the Carter administration when we had this thing called stagflation. There were certain techniques that evolved and certain methods of handling the pending recession that came with it. And we're going to be talking about that today because if you're using a lot of debt to acquire a company, and as a result of that, interest rates go up and you're caught with these excessive payments, or if the recession hits you in a way where you don't have the business coming in to support the debt that was used to acquire the company, you can see where that could put you in a big disadvantage. And so today we're going to show you one way to correct that problem so that when you're looking at opportunities out there, you're not put off by the fact of the what ifs. What if the economy does this? And what if the economy does that? So that's where we're going today, and hopefully you're going to find this really helpful. All right, so if you have any questions as the seminar progresses today, just type them into that panel on the right-hand side. That way they'll be there and I can address them at the end. Or raise your hand if you want to ask your question or comment live. And again, if we don't get to your questions, just send us an email at question@bizarrefinancing.com, and we'll try and answer them as best we can through the email process. Okay, so all that said, I want to introduce you to a type of financing which you may or may not be familiar with, but most aren't. And the word is unitranche, and that's how you say it, unitranche. And the financing for acquisitions using unitranche is a way of financing, is a smart way of arranging the financing for an acquisition. And we're going to take you through it today. We're going to show you how it contrasts to the traditional way that you would be normally doing a financing, the double escrow, the asset-based lenders, and all the different lenders. We're going to show you the difference, and we're going to show you how it works, and especially how valuable it is given the uncertainties of the future economy. So the first thing I want to do is actually compare it to a traditional financing. So before I get into the unitranche, let's just take another look at traditional financing, okay? In a traditional financing, you're going to have secured debt, right? And either the asset-based lenders or banks. You're going to have unsecured debt, and this can come from what are called mezzanine lenders. And then you're going to have some portion of equity investment, and it's either going to be you, or it's going to be private investors, or it's going to be institutional investors. And this is typically where the money's coming from to do the acquisition, with one additional source being seller carryback. In other words, the seller might have a loan back to the company to cover a portion of the purchase price, which you're going to pay for that over time. So we don't include them in here, but they're definitely a part of it. As far as the other sources are concerned, these are the basic ones that you're used to. All right, so now the question is, what's the uniqueness of these guys? Okay, if you look at these folks up here, the secured debt, okay, what's securing them are first liens on all the company's assets, and they are liens at some loan to value ratio. In other words, the loan was made at some relationship that's something less than the actual asset value that's going to be behind the loan, so that the lender is protected by that collateral. Should you not pay, they foreclose on it, they get paid, and since the collateral is supposedly worth much more than the loan was made to you, that the risk is very limited to the lender. So it looks something like this, okay? Here's the different things that you would normally finance in the transaction. And here's the LTV ratios. In other words, if you're financing accounts receivable, the loan you'll get is pretty much going to be 80% of the accounts receivables. It's going to be 75% of any real estate, probably 65% of any equipment, 50% of any inventory. Furniture and fixtures are not readily that much, and you might throw in some 10% of their value. And then the other assets of the company, which can be anything from contracts to unique situations where the company has access or a resource of some kind that has value, but it's not in the category that banks or asset-based lenders finance. And whatever is in the company, they give you zero credit for that. Okay, so that doesn't count. So whoever those lenders are on the secured side, they're going to want to have first liens on all the company assets. So all of these assets are going to be pledged to these guys for making the loan. If you look at what they're loaning, okay, if the loan is these amounts here relative to the values, then there's excess value in these assets that go beyond what is necessary to cover these loans. And in the case of accounts receivable, there's 20% there. That's excess. There's real estate. There's 25% of the real estate. These are called debt equity. Okay, they're equity that you have. You just can't borrow against them, right? So you have another 35% of equipment against the equipment, inventory half, furniture and fixtures 90%, and then any and all of those other assets, there's 100% of them that you're not getting credit for. So all of this has value, but you don't get credit for it above and beyond these secured lenders and the amount they're going to loan you. Okay, so I've over described that picture. Hopefully that everybody is very clear on what's true for these secured debt, the secured debt. And what this means is that you have a low risk by these people. You have a relatively low money cost, especially from the banks, relative to other financing components. So if you wanted to get into these financings here, these are all going to be way more expensive because they don't have any liens against these assets, okay? They're totally exposed. If you look at the unsecured debt from a mezzanine lender, they have no liens on the company's assets. They have a high risk as a result of that. And then there's a high cost and or equity participation that they're going to want because they're incurring that much higher risk. So you have these folks that are overprotected, and these folks here are naked, right? They don't have any protection at all. And then it's even worse for these guys over here, the equity component. They have no liens. They have the highest risk because they're going to lose before the mezzanine guys lose. And so you have here the highest cost. It's the hardest to get. And to get it, you may possibly lose control, okay, of your company. So this is the picture for traditional financing. So what is unitranche financing going to do that's different? How is it that's going to work? We're going to get into that. But the first thing I want to ask you is, what's wrong with this picture? Okay, what is wrong with this picture? All right, and if you have a sense of it and you want to shout it out, I'll be glad to open up your mic and let you do it. And if we don't have any brave souls, but what I'm going to do is just tell you, okay, here's what's wrong with this picture, okay? And yet this is the picture that's been used almost 100% for financing acquisitions, okay? But there's something wrong with the picture, and here it is, okay? You have all this overprotection for these guys, leaving these guys naked and charging much more money than they'd have to charge if they had some protection. In other words, if there was a way to get this excess protecting these guys, then they wouldn't need to have the high risk premiums that they charge in order to provide these levels of funding. So what unitranche does is it means the funding is going to come from a single source where the risk coverage for mezz and equity lower cost. So instead of having 3, 4, 5 different lenders and investors in a package that you put together to cover your deal, it's literally one source that handles the whole thing, okay? And for this portion of the financing here, in other words, it still is structured the same way. There's still asset-based loans, there's still mezzanine lending, and these are done, especially these, are done at their market rate, okay? This is so you won't have any different charge for these than if you went to the bank, but you get a lower rate for these and a lower expectation of equity participation because in addition to having their loans covered, they also have this excess that now can protect part of this portion of what they're doing here. So even though the ledger still breaks out the types of lending and equity and all of that, for this portion of it, they get way more flexible with you because they've got all this excess coverage. So hopefully that makes sense, okay? In other words, up till now, it's only the banks and the asset-based lenders that got this. Now, through unitranche, one source provides it all, and so now they've got this excess to cover some of the risk factor that they're taking here, okay? Now, if you think about it, that's a much better picture for the lender and a much better picture for the investor, whichever you want to call them. But now the question is, how does this work? Well, let me see an example. In other words, what's it going to do for you, the person putting the funding together? So let's take you through an example of how unitranche financing actually works, all right? And basically, it's going to look something like this. And I constructed a basic example, tried to use sort of rounded numbers, so it's a little easy to follow. But we basically are looking at a purchase price of $10 million for a company. And in here, we've already included the costs of closing and everything. So the total number that has to be done, that has to be totally financed or totally covered is your purchase price of $10 million. Now, again, I didn't include any seller financing in here. That would be just more leverage that you'd have to use, but I kept it out because I don't want to complicate the picture with anything more in the picture than has to be there. So we're assuming we're going to purchase this company. We got no seller financing, and here's how we're going to get our money. All right, in the company that we're buying for $10 million, we're taking a look at the asset structure, and the assets are going to look something like this. Let's say we have accounts receivable, $1 million. We have real estate, $4 million. We have equipment, $750,000. We have inventory for $1 million. We have furniture and fixtures for $250,000, and there are other assets in there, all kinds of various and sundry kinds, valued at another $400,000. So the total assets of the company are $7,400,000. So we have a company we're buying at 10. Its cash or its assets are $7,400,000. So the argument here is that there's $2,600,000 worth of goodwill value in this company, which nobody's going to give you credit for ever in life. So that doesn't count, but we're paying for it because we're paying $10 million for assets that only are $7,400,000. So what we're not covered by with all these assets is that goodwill value. So moving on, each of these has a loan to value ratio, right? So if you look at the loan to values, which we've already covered with you, then what is the amount of the loans we're able to get against these assets? And so we're going to look at $800,000 worth of accounts receivable loan, real estate $3 million, equipment 487.5, inventory 500,000, furniture and fixtures 25. So lo and behold, we're going to be able to borrow $4,812,500 from what normally would be the asset-based lender in the bank. But remember, this is all going to come from one source now, but they're still going to break it down and look at it the same way. This is the amount of loans against the assets. Here is our excess that we have that isn't directly related to these. In other words, it's related, but it's over and above what's necessary to cover those loans. This is the amount of the excess. There's $2,587,000 excess value in these assets over what we're being loaned through the typical model. Okay, hopefully everybody's got that. So if we can get this amount of funding here, this amount right here, okay, from these typical sources or typical structures, then we still need to get our 10 million purchase price, $587,500. So that's still the amount we got to come up with. All right. So that means we've got that money's going to come from someplace, and it's going to come from equity and it's going to come from mezzanine financing. These two are now what's going to supply the difference. So this is the amount we need. Now, I did a little calculating beforehand because I know a certain relationship, and the relationship is that for every dollar of equity money I have, under most circumstances, I can borrow from mezzanine funding 2.5 times my equity. So a little bit of math, if I have $1,550,000 of equity money that's coming in as an investment, that gets multiplied by 2.5 times to determine the amount of mezzanine financing, that amount of loan that I'm going to be able to get. So that's $3,875,000. So the total equity and mezz raise is $5,425,000. But I only needed $5,187,000 of additional financing after this was covered. So that leaves me with a little surplus here of $237,500, which I'm going to just earmark that for extra working capital in the business, some extra cash just sitting in the business's bank account. All right. So now this is where the funds basically are going to come from. So the cost of the asset portion of the financing remains the same, but costs of equity and mezz are reduced due to some risk protection. In other words, this is still the amount of money that I have to raise in these segments of the financing. But because I have this over here to protect these people now, which before, remember, they were naked. They didn't have anything protecting them. Okay, whatever it costs me for these things is now going to be less because this is offsetting their risk that they would have taken had they just come in as in the sole components of these things. So again, hopefully the logic of this is making sense to everybody. Now, arranging this is going to be a lot easier to arrange if you put up $250,000 of equity to show your skin in the game. So in other words, of this equity money here, ideally, if you put up $250,000, it's going to be a lot easier to raise the other $1.25 million roughly that it's going to take to do the rest of this. If you don't, then you're going to find that these folks here are going to want to really sock you with high cost of money if they'll do the deal at all, and even be talking they want control. So now the question is always going to be, all right, where do I get this, right? Where is this going to come from, this $250,000? There's a thing called transaction funding, and you do that for $250,000 that is paid from the closing. So in other words, there's going to be $250,000 of transactional funding that's going to look like your money going into the closing. It's going to be built into the closing costs and extra funds for working capital. This money that you set aside here, you're going to use that to, after the close, in effect, get your $250,000 back. But it's the transactional funding that will actually be taking this and some other costs that are built into these costs up here that were included in here for the way in which you get the money back to the transactional funder. This is like equivalent to double escrow, but it's even better because nobody sees it ever. So your transactional funder gets paid back right out of closing. They put up the $250,000 in the escrow. It looks like your money, and they get paid back out of the fund, this funding down here, and some costs that were built into the closing costs up here. Okay? So you've done this now, no cash of your own. You've got all of the pieces built in to handle it. You've reduced the cost of your equity funding here and your mezzanine raise by the fact that we protected them with this extra value that normally would have been wasted in a traditional transaction from the standpoint of your funding. Okay? So again, hopefully everybody's got that. If you don't, make questions, write them down. And if you need me to work through it again, I will. But to help see it, let me continue on the example, okay? All right, this is now going to go an additional step, because we said when we started talking together here today that we were going to show you how, given the fact that everybody's talking this pending recession, you don't want to go buy a company, and then if the economy goes to hell for a few years, you get caught with all these payments that are excessive, and your company's in danger because now you got negative cash flow, you got all those other problems because your debt service didn't go away, but your income did. All right, so here's how that all works out now. So when you negotiate the equity portion of the financing, what we're going to do is we're going to overfund with more shares at the agreed value per share in exchange exchange for the following concessions. All right, and I'm going to give you a hard example of this. So I just want to take you through the narrative, and then I'm going to give you a hard example. We're going to define the trigger events that would create difficulty meeting payments on the debt portion of the financing. So we're going to say if income drops below X, if what triggers it, if the recession index for unemployment happens, it's going to trigger. Okay, so we're going to define things that could adversely affect us in the marketplace, and I'm going to show you what those would be, but I want to give you the concept first. We're going to define these trigger events that would create difficulty meeting our payments on the debt that we borrowed to buy the company, right? Okay, those events become the triggers that allow you to defer debt payments for some number of months into the future, or are refinanced back into the loan and paid over time. Remember, we got a single source of the money now, right? And believe it or not, they're going to be open to this because the stronger you are, the more secure they are that you're going to meet your payments come hell or high water, and it's all built into the agreement that they have with you. The fact is they're going to be happy because they don't want to ever foreclose on you. Nobody ever wants to do that because they know they're going to lose if they do. So if we can build a process that protects them, they're going to be happy to hear us out. All right, so now the next thing is those events can also trigger additional loans that can also be paid back over time. So in other words, not only don't you have to make payments, but if push comes to shove, they're going to loan you more money to get you through those tough months or those tough year or 2 years, whatever it is. And we can build in a lot of protection here. And I'm going to show you in a moment how we do that. All right, so here's the example. Here's how our equity raise went, if you'll recall. Okay, we came up with 250,000. The Unitran folks came up with 1,300,000 because remember it was the total was 1,550,000. The valuation of the company based on a pro forma that we did, and we'll show you at another meeting how to do this, another seminar how to do this. But you do a pro forma 5 years, which shows the growth of the company that you're expecting and the value of that company based on you're achieving these things and for which you have a business plan. And it's a business plan that has to be credible. But remember, you're not buying this company to have it sit still, right? You're buying it because you know exactly how you're going to structure it and how you're going to operate it to make significantly more money than the seller had. Okay, because if you can't do that, you shouldn't be buying the company in the first place. So that's almost like a prerequisite to doing it. So you have, based on your pro forma, you're saying the value of the company is $10 million, which isn't a far stretch, right? Because that's what you're paying for it. And technically, that's what you valued it at purchase. The unitranche percentage of the company, let's say, is, so in other words, when you made your agreement with this unitranche folks, remember, they're going to get an equity participation in the company because they're equity people, right? So the deal you've made with them is they're going to get 13%. And the company issues 1 million shares with a value of $10 each. Okay, it's a $10 million valuation of the company. So your company issues 1 million shares. The value of each share is $10. So they are to receive 130,000 shares that are valued at $1.3 million. So that's what they're going to be getting for the investment portion of the unitranche financing. But what you do after this has been agreed to is you offer them more. You offer them not 130,000 shares. You offer them 175,000 shares. In other words, 17.5% of the company that they're going to get, not 10. Now, why are you doing that? You're doing that because you're doing that in exchange for recession-proofing the company. They are, in fact, getting an additional $450,000 in stock value in order to make those concessions to you. They ensure the success of the company and the value of their entire investment. And your cost, nothing today, and 4.5% of the company that doesn't matter to you until someday if you go public or you sell the whole company. And by then, that 4.5% is gone in the noise. And what you just did is you gave them an incentive of literally a value of $450,000 for no cash out of your pocket to allow you to defer payments and to provide you with additional funding if your company runs into trouble and it's triggered by the events you've defined with them. So hopefully that's clearer than mud and that you've got it. So in times of trouble, payments are deferred, additional funds are provided, or no out-of-pocket cash. You just eliminated the only danger of using high leverage to acquire a business, right? This is a bargain, okay? That 4.5% extra that they get of the company, it's a bargain for you. It's insurance for them that you're not going to have any hassle if the economy goes south for a while. So everybody wins with this arrangement. All right, questions? I'm sure you got some. Let's talk about it. I see a hand up. I love a hand. All right, let me go to that person. It's Meyer Patricia. I don't know if your name was reversed there, but Patricia, can you turn your microphone on?
I actually raised my hand on accident, but I do have a question.
Well, hey, listen, it's a pleasure to talk to an accident. Thank you.
Okay. What are the examples of what we can put in for the concessions? Like you said, a recession, or can you give us some examples that we could put in there of
Sure.
the triggers for deferring the payments, et cetera?
Yeah, exactly. Okay. In other words, definition of these will always be nuanced by the type of business that it is and how your income comes in and what would reduce your income coming in. But essentially, you're looking at what are the things that would happen to you or your company in a recession or in something where it's beyond your control. In other words, if you're not running the business well and the economy's doing fine, your sales are going down. That's not what would trigger these things, okay? What would trigger these things is the things that would be beyond your control. So there are either government elements that could come into effect in a recession, especially one where you have inflation. In other words, the inflation factor goes above a certain point. And what that means is it could be tied to the inflation index, it could be tied to the prime rate index, because as the interest rates go up, it gets harder and harder for you to make your payments, right? Because you're having to pay more and more interest. So if the interest rates go above a certain point, you get deferment, okay? So that way, the lender portion of this is still getting technically their interest rates, it's just they're not getting it now. So that deferment would be pushed back into months when the economics of that turned around. You could do it with the amount of the recession. In other words, every recession has metrics that the government publishes with respect to the recession. Its employment rate, it can be anything from the inflation rate to the interest rate to I'm trying to think of the best one here for a recession. In other words, if the total economy drops 3 to 5%, okay, over a period of time, for every 1/4% drop as a result of inflation, in other words, of negative growth, that you get X amount of forgiveness on your debt. Okay, it's not forgiveness, it's deferral. So the whole idea is to structure this so that the single source of the money, they don't lose by this, but they're well capitalized. So they just get to absorb the shock until it straightens itself out and then you can catch up. Does that make sense?
Yes, thank you.
Yeah, you're very welcome. Very welcome. All right. Anybody else have any that they want to cover with us here today in the way of question? And you can type them in, you can talk them in, you can do. All right, we got a question here. Let's see how that works. Oh, I just lost it. Where'd it go? There it is. All right, it says, how do you mitigate the current astronomical raise of real estate prices versus more than likely upcoming recession? First of all, you buy real estate. And one of the reasons we're doing what we are in the multifamily residential real estate area, in other words, we're buying apartment houses, we're syndicating them amongst investors. And because of the anticipated inflation and the rise in values of those properties over a 3 to 5 year period, we're going to be able to easily double and triple people's money that's invested in these because we're borrowing 80% with federally backed loans because the federal government wants people to be able to get housing. So we're able to borrow 80% of the purchase price now at 4% money, and that money's not going up, it's fixed. And so the leverage of 20% equity to the growth of a property that's only got 4% interest on 80% of the value of the property is huge leverage. So we'll share that with investors, and that gives us the ability to attract investors to that as a hedge against inflation and to give them a great return on their money and to give us ownership of some incredible properties. So that's one way to capitalize on the increase that these properties will have in cash value, not necessarily real value because that will all be eaten up by inflation, I'm sure, but it's a way to capitalize on the increase in price value as a way of doing this. Okay, now you add to your question here is how do you incorporate a drop of 5 to 10% loss of real estate price in the Unitran transaction? Okay, when you say 5 to 10% less of real estate price, I don't know where you get that from because everything that we see say the price of the real estate is going to go up. Now, this may not be true in commercial real estate. See, commercial and residential are very different. Okay, residential, everybody's got to live someplace. The government's going to help you finance it because they want to have the ability for people to have affordable housing. So they want to protect the real estate industry because that protects renters in their ability to be able to actually rent property. However, for commercial, it's different. And there easily could be a 5 to 10% loss of their real estate value. So one of the things that you might want to do is to spin off the realty, not include it in the purchase. And you do that by a sale leaseback. Let somebody else take the risk of the property value going down. You fix your cost in terms of a lease arrangement with them, and you convert that asset back into cash that instantly pays itself off. You're buying the business, it's got the real estate, you flip the real estate, but you can do that right in the close. You set up your sale leaseback with the leaseback company's money going right into the escrow that closes out the transaction. And now you've cashed out that asset, and now you don't have to worry about it. So now your single source finance group is now financing everything else in the company with all those other things being true as we explain them. But the real estate has been extracted from the transaction through a sale leaseback. So if you have more question about that, I'll be glad to explain it, but that's essentially, hopefully answers your question in full. Cool. All right. Any other questions here? I don't see any other ones. All right. Well, you can make this a short day for me. I was ready for a bunch of questions here. By the way, I really like financing. It solves problems for everybody that are typical in a traditional type of financing, because the only folks who were really protected in the other traditional form of an acquisition were the banks and the asset-based lenders. Everybody else was running naked. Now we take that out of the equation and we have everybody protected by that extra asset over and above the loan to value ratio that was going to the other folks. So we don't overprotect them. Everybody's just better protected. All right. Well, listen, if you don't have any questions for me, I got deals to do and I'm going to go get them done. Just to tell you what we're working on, we are really made a lot of progress on this jet charter company that we're looking to acquire. We're well into the negotiations now. What we're finding is that we're able to use scale for and billionaire lifestyles and that strategic aggregation to become very attractive to not only the jet company, but also a whole bunch of other companies that their clientele is the uber wealthy. The fact that these folks that are very wealthy have a way that they spend their money where they have common type, where there are many resources that service them, where they're the common clientele of those businesses. And by aggregating those companies together in a strategic aggregation, i.e. billionaire lifestyles, supported by Scaleforce, the jet charter, when they're looking at what we're doing in the way of acquiring them, leaving them with a percentage ownership in the company so that they can participate from the growth that's going to be propelled by Scaleforce and the strategic aggregation. We're able to get them excited, and we've already pulled them away from the competitors who were trying to get the company, who could only offer them a value based on their current traditional value, as opposed to sharing with them the value that we can help them create through that strategic aggregation and through the Scaleforce automation of that whole cross-marketing and cross-selling. So that was a really big element that we're able to add that knocks out the competition and gets the folks that we want seeing us as the best buyer for the company, and where they get to have a share of the win with us that gets them very excited. We're doing something similar with this agricultural group out of New Zealand, and we're very far along in buying out another company that's not a competitor of theirs, but they are exactly in the same business. They just do it in a different part of the world, and they're bigger than they are. They're 7 times their size, but that person is retiring, and the idea that they can only get so much for the company by selling to other seed companies or other public companies that are agricultural based, we have a better business model for them. We have a better acquisition structure for them. And so we've knocked out the competition there as well. So those two are just doing super, super well. And it's a real bonus for innovation and creativity in acquisition, that you don't just go after everybody in the normal way. You allow yourself to think out of the box. How do you bring new values to the acquired company and their owners? And how do you share that value with them in a constructive way to knock out the competition and make sure that you get the deal as opposed to somebody else? Bent, I see you have a question here, so let me see if I can get at it. To do the sale leaseback in escrow. Okay, how to do the sale leaseback in escrow. Okay, what you do is, let's say that you already own the company, right? You already owned it. If you didn't want to own the real estate anymore and you wanted to do a sale leaseback transaction, how would you do that? There are companies out there that do that. That's their business, is taking real estate that people would rather lease than own, but they already own it, and they'll buy it from you and lease it back to you, and that's their business. Okay, so there's no problem finding the companies to do that. They advertise they want to do it. Okay, so the question now is, okay, you don't own the company yet. If you remember our double escrow technique, it's the same type of thing. They become part of that double escrow in effect. They put the money into the escrow account for the leaseback, for the purchase. You have the lease agreements already signed as if you were the owner. They're already sitting in the escrow. So when the escrow closes, they get all the paperwork, you get the money, everything's done. Okay, and that way you get the money that you need to cover the closing. So it's no different than the double escrow technique. It's not done any different than if you already own the building, except you don't. So you do the paperwork through the escrow so that when the escrow closes, you do own the building, and everything's now signed and facilitated by the fact that you are now the owner of the building when the money actually changes hands. So that's basically how that's done. How do you join Scaleforce? Well, it depends how you want to join Scaleforce. Okay, you can join as a solution partner, where you're one of the businesses that provide solutions to this network of providers who all have a common type clientele, or you can be part of it where we would help you where you would be one of our provisionaries in the process, where we train people to be what are called, in this case, the certified concierge professional. Let me give you an example. I don't know if this is what you're asking, but let me give you an example. If we have a person who is a very wealthy person, they love convenience. They love having things work where they don't have to worry about them. They don't care about the money. They just want to live a life of ease, convenience, and privilege. Okay, and every day that goes by, that's happening for them, and it's seamless with no hassle and no aggravation. They're happy folks. We look at all the things that the wealthy people want to be true for them. And then we train a person who is a concierge type function. And we create a nation that when they're fully trained, they will be qualified as a certified concierge professional. That party will supply the services that those wealthy people want. But we have software that ties that person into every one of our providers, and every one of our providers is tied into that software, which makes them working together seamless. So what Scaleforce does is it enables all of those solution providers to function into one system where they're seamless in how they work together. So if I get an order from another provider's client to do something for them that's facilitated through that concierge professional, everything is handled in the system, and I can track it and see it and integrate it with every other service provider that I need to work with. Okay, so let's say I'm the concierge professional and I get either a text or a call from one of the clients of one of our solution providers, and they're saying to me something as simple as, I need to get to Boston and back in the quickest way possible, and I need you to just set the whole thing up for me. We're going to have a set of preferences already in our system for that wealthy person, but we'll handle everything from the limo that picks them up, which will be one of our providers, to the private jet that'll be there at the runway ready to take him to wherever he wants to go, to the limousine service picking him up, to the hotel or private residence that he'll be staying at. So it's like pillow to pillow. Everything is handled for them, and that system, Scaleforce, enables it to be integrated with every single one of our providers, and all of the handoffs from one provider to the next provider to the next provider are all built into the system. So once everybody's plugged in, it's as if they were operating as if they were one company with everything automated and facilitated through that system. So it's convenient for the wealthy person. It's fantastic for each of those service providers. Whoever was the source of the client, they're going to get a revenue share from every one of those services that we provided. Build out that client for those services. A little portion of it's going to go off to whoever was the original source of that client. And so everybody's got more clients than they would have had. And the people who are bringing their clients into the system are getting extra revenue from all these other service providers that they never saw a dime from before and never could work with them before. And everybody won, from the wealthy person who had seamless travel, ease, no hassle, handled with one phone call or one text. All of those things are facilitated through that system, and it's got different benefits in different industries as we strategically aggregate them. But that's how it works in the travel industry in particular, but in anything that wealthy people spend their money on, that's part of that system. It's a mouthful. It's very hard to explain simply to people because it's not simple. And when we started this system, everybody said it was too complex. You can't do it. An automobile's got 30,000 parts in it. You get in and drive it, and you don't worry about the 30,000 parts. You just steer it, you brake it, and you step on the gas pedal, and you go. Okay, and you don't care about all that complexity. So we just reduce the complexity down to automation through technology, and we let the technology do the work, and we set it up so that the folks just have to get in and turn the steering wheel and drive, and that's what the system is set up to do. So we believe that's the future of business. We believe that's the future for wealthy people who don't want to have these hassles and just want ease and convenience and to have those things handled for them. And then we do other things for them too, like with that database of people, we know who's in what industry, who's in what business, who is what ways in which they develop their wealth, and so we'll be sponsoring for them getaways or meetings where we bring together a mind meld of the key movers and shakers in certain areas where they can actually now, by our proactive invitation, take part in things that will benefit them and help them to create more wealth and share ideas and innovations with people who can benefit them. Most people don't realize this, and it's a little bit of an aside here. Everybody knows there's this place in Florida called Palm Beach. And if you've ever driven along the main road along the coast, or if you've been in a boat and you've gone up the coast, you see all of these mansions, incredible mansions, one to the other, after the other, goes on for miles. And substantially all of those mansions were actually built at the turn of the century, not the last century, the turn of the 1800s to the 1900th century years. It's where all of the folks who were involved in the Industrial Revolution, the Fords, the Vanderbilts, the Rockefellers, all of those folks from that generation, it's where they all built their vacation homes, their winter vacation homes. And the reason that they built them there is they would all arrange to be there at the same time. And they took that opportunity to share with each other what they were doing, how they were doing it, what their opportunities were, what challenges they had, how they were going to look to overcome their challenges, how each could contribute to the other and help the other sustain and receive remuneration or reward from the things that they could do in exchange and interchange with each other. And it's part of how they developed their wealth, because they had this mastermind of all of these incredible, inventive and knowledgeable and resourceful people who got together for that purpose. That doesn't happen much anymore, and it certainly doesn't happen in an organized way. So one of the things we have the opportunity to do with Billionaire Lifestyles is to proactively set those opportunities up for the very wealthy people that are amongst the client base of all of our solution providers in that system. The answer to your question, Bent, is how do you join Scaleforce is you just call me, okay? And you have my number, 805-497-1000. You just give me a call. If I'm busy, somebody will take your incoming call and I will get back to you. I'll talk to you about whatever it is that you need to know to understand how you can integrate with Scaleforce, what it can do for you, how we can make it available to you. And I'm happy to have that conversation. All right, let me see, what's the next one here? All right, I think I got everybody's question. All right. So I got 5 minutes left. I didn't do too bad. I filled up the hour, hopefully with beneficial information. And I want to thank everybody for being here and being part of this today. And I look forward to seeing you during the next one of these that we have, which will be the 4th Wednesday of this month. And then the next Pro one will be the 2nd Wednesday of next month. So until then, I wish you all the success.